You're watching Bloomberg Law. I'm Pacchia. Last week, Manhattan District Attorney Cy Vance filed criminal charges against Abacus Bank and a number of its former employees for allegedly issuing hundreds of millions of dollars in fraudulent mortgages that were then sold downstream to government-backed guarantor Fannie Mae. Joining me now to discuss is Bill Black, professor of economics and law at University of Missouri, Kansas City School of Law. He's joining us via Skype from sunny Honolulu, Hawaii, where he is currently giving a paper. Professor, thanks so much for your time today. Welcome.
Thank you.
So Abacus has 7 branches, something like $250 million in assets. They are a tiny bank, all of a sudden in a heap of trouble. When critics of Wall Street have called for prosecutions of banks for committing mortgage fraud, is this what they had in mind?
No, but, we're happy to see them prosecute even here because it puts the lie to the claim that there's no way to prosecute fraudulent lending.
You're quoted in the press as saying that the allegations described in the papers are practices that are the norm for so-called liar loans. Liar loans, at least as far as I understand from accounts in the press and media, were relatively commonplace before the crash. That is to say, this is something that banks just did. So that said, should we be seeing tons of banks and employees prosecuted in coming weeks and months for committing mortgage fraud?
Well, you should, and it should be hundreds of senior officers at hundreds of banks, but you're not going to see that. You're going to see only these tiny cases, and then presumptively in the run-up to the election, they're going to have to find somebody significant to finally bring a case against because it's just so embarrassing, the complete impunity right now. So let me give you some numbers. And I'm also a former financial regulator, and I have a doctorate in criminology, and I specialize in elite white-collar crime. Mm-hmm. By 2006, 1 out of every 3 home loans made that year was a liar's loan. The incidence of fraud in liar's loans is 90%, 90. They're virtually all fraudulent. We know that it was overwhelmingly the lenders and their agents who put the lies in the liar's loans. And we know from a Federal Reserve survey in 2005 by a senior supervisor, Mr. Sadiq, and what I'm about to describe comes from the Financial Crisis Inquiry Commission report. Mm-hmm. It found that it was a survey first of the largest banks, not the tiny ones like Abacus. It found that the percentage of non-traditional loans of all mortgage loans at these large banks was ranging from over 50% to roughly 15%. So the big banks were massive players in this, and it found that roughly 3/4 of the non-traditional loans by the biggest banks were liar's loans. Mm-hmm. Mm-hmm. So that is, we're talking about, over 1 million cases of fraudulent loans a year. That's just by the big banks. Overall, we're talking about over 2 million fraudulent loans a year by 2006.
So let's unpack this. Why did the government go after Abacus of all banks? This is a small player in a crowded space. Is there something that Abacus did that makes them stand out? Or is this, as I think you were alluding to before, is this really a test case for a bigger, more significant prosecution that might be in the offing prior to the presidential election later this year?
No, it's not a test case because you would never do that through, this isn't even a state attorney general. This is a district attorney in Manhattan. So the federal government would be the one bringing in a test case. And Schneiderman, who is in charge of this working group that is only looking at a subset, by the way. It's only looking at what happens once you sell these securities essentially to Wall Street. He just hired a former federal prosecutor. So, the state prosecutors like Schneiderman don't have the trial experience in the federal courts to bring these actions either. And of course, to hire a new attorney at this point, and it's a she, and she has to come up to speed and get the case filed before November. That's already quite a rush. Now, what's happening is, and we can't overemphasize this enough, the Justice Department can't bring significant number of cases. It can bring the episodic case like Abacus, but it can't bring a significant number of cases without criminal referrals. And the reason is we got roughly 1 million people in our criminal justice system as employees, not counting the prisoners. Virtually all of them do blue-collar crime. There are only around 2,000 FBI white-collar specialists. We have 1,300 industries in the United States. That means, if you generous count, we have 2 FBI agents per industry. So they obviously don't walk a beat within the industry. Mm-hmm. They only come when criminal referrals are going to be made. And here's, of course, the key. An institution is not going to, a bank is not going to make a criminal referral against its own CEO. So those can only come from the banking regulatory agencies. In the savings and loan crisis, which was 1/70th the size of this crisis, our agency alone, the Office of Thrift Supervision, made over 30,000 criminal referrals. The same agency was supposed to regulate Countrywide, Washington Mutual, IndyMac, all massive makers of fraudulent liars loans. That same regulatory agency made 0 criminal referrals in this crisis. The Office of the Comptroller of the Currency, which is supposed to regulate the largest national banks, made, depending on which spokesperson you believe, 0 or 3 criminal referrals. The Federal Reserve, which deals with the largest bank holding companies, made 3 criminal referrals, according to the Financial Crisis Inquiry Commission. The FDIC was smart enough to refuse to answer the question.
Bill, you pointed out before we hopped on this program that it's unusual for a bank to have a criminal prosecution against itself and former employees, yet management's still in place, the bank's still operating. How do you expect this to play out, given that the bank's still doing business today?
This is completely nonsensical, right? If the bank is sufficiently involved with the fraud that it's appropriate to hold the bank criminally responsible, then the bank should be in receivership. You should get rid of the managers and you should bring in new people. To sue criminally, to bring a criminal action against an open bank is an excellent way of causing the bank to fail and potentially inducing a run as well. So this makes no sense. And what you're seeing, again, the same thing I was describing in criminal referrals. The dog that refuses to bark are the banking regulatory agencies. And unless they bark and help the Justice Department bring these cases, the Justice Department will never do it right. And let me tell you the other thing that's going on here. Our resources have been completely misapplied, and we don't have vaguely enough resources. To this date, there has not been anything that would pass for a real criminal investigation of any of the large entities whose frauds drove this crisis.
Right. But as you say that, if we're going to look at a large entity and talk about a criminal prosecution for the way they handled mortgage origination and securitization, it calls into question the too big to fail problem. You could potentially knock over a bank that has systemic importance. Is that part of the reason why regulators and law enforcement are so reluctant to bring these types of cases against larger institutional banks?
Well, let me first react to the word you use, systemically important, right? That's the theory that the administration puts out. But that's not the definition of these institutions at all, right? The reason that we bail out their general creditors in the event of their failure, and hence the too big to fail, is not because they're important. It's because, as you said, they would cause a global crisis. So let's call them what they really are, systemically dangerous institutions, not important. But yes, it's not really coming from, frankly, the regulators, because we know how to put an institution in receivership, open it the next day with better management, and in fact, runs on such institutions do not happen. What this is coming from is Treasury Secretary Geithner. And there's been reporting, by the New York Times, Gretchen Morgensen, about the fact that he went personally to Cuomo when Cuomo was the Attorney General of New York and urged him not even to investigate, much less prosecute, the largest banks, claiming that that could be destabilizing. So I must tell you, as a former financial regulator, how much more intelligent the Geithners of the world are, because we had never figured out that the way to financial stability was to leave fraudulent CEOs in charge of the largest banks in the world. This is really very clever.
That said, are you surprised that we're seeing any criminal prosecutions against any banks of any size?
No, because this one was handed to them because of Fannie, almost certainly. So Fannie Mae has fraud investigative folks, and this one shows, this case, I want to congratulate them for bringing the case, and I don't want people to think that it's easy to bring white-collar cases against elite criminals. It isn't. But we got over 1,000 felony convictions of elites, and we had a 90% conviction rate. So it takes a really long-term effort by large numbers, as I said, 1,000 FBI agents, hundreds of prosecutors, far more resources. I mean, you need 15 times the resources we currently have to make a serious dent in these things, but it can be done. And this case demonstrates it, that when you go into the institution, what you haven't mentioned so far is that there are a significant number of plea agreements already in Abacus.
That's right.
So all the lowest tier of employees basically have pled guilty. Now, you have the ridiculous concept that this ended with a chief credit officer. Like he could pull this off, and no one in senior management knowing about it. One assumes that they're trying to flip the senior credit officer so that he'll testify against the senior management in the C-suite of this place. But as you say, this is a relatively small action. It shows if you go in and investigate liars' loans, they're so pervasively fraudulent that you can make the case and you can flip your way up through the organization to the bigger cheese who actually caused the frauds.
All right, Professor, we're going to have to leave it there for now, but I want to thank you so much for your time today.
Thank you. Take care.
That's Professor Bill Black from the University of Missouri, Kansas City School of Law. If you'd like to learn more about the case and issues we just discussed, be sure to check out our offerings on BloombergLaw.com and also on the Bloomberg Terminal. You can follow our updates on Twitter and see more of our videos on YouTube. I'm Pacchia. Thanks for watching.